you, yeah. So as many of your founders, and even if you're not, it's pretty obvious. Let's focus on the Cocoon slide with the hurdles. We can. Anyway, every founder's journey has a challenges and obstacles on their journey, and the challenges can be either external or internal. External being like market, if the market is down, COVID, for example. Internal challenges can include something like fear, different negative behaviors, victim mode, low self-esteem, not listening, escapism, so forth. And if you don't work with these challenges, you end up wasting so much energy and avoid situations. So Cocoon actually helps you through these challenges so that you have energy to grow faster and get further and push further into pushing your limits. And to learn how to get on the fast track, you can use the link on the picture to get one free mentoring with the Cocoon mentors. And if we can go to the next slide, this is essentially, you have the fast track. You can enter 3-month trial period with or full experience. And there are such things as training days and mentoring groups and so forth, and including one-on-one mentoring. Now, let's get started with the investment 101. So I see that many of you, if we can focus on the 1 million question, 1 million euro question, most of you seem to be wanting technology companies. I see Meta, formerly known as Facebook, NVIDIA, OpenSea, Palantir, new AI company, not so new maybe. I did see something about a company that eliminates plastics, so I guess sustainability. Miro is a great company to invest in, if we can invest in them. But I noticed that most of it is in technology, which is quite interesting because I think many investors feel the same way as well. So can we go to agenda section? So here's the agenda for today. It should take about 30 minutes to 40 minutes, and we want to start taking questions. So I want to start with a quote from my founder, and I think most of you probably heard of a book called Sun Tzu, The Art of War, a little snippet from there. And I want to cover the investment methodology, and then go into more details about what it takes to get investment and what to say, what not to say with investor when you're in the meeting. Go through the valuation. I'm tempted to ask how many of you are struggling with coming up with your own valuation. And I have some gifts for you for those of you that are still with us at the time. And of course, we'll open for Q&A. So we can get to the next slide. So quote of the day. I don't know if you can read, but one time a founder came up to me and said, you know, I met with 95 investors and I wasn't able to raise a single euro. Verbatim, true quote from a founder. And well, basically what we're gonna do today is to make sure that this does not happen to you. So you don't end up becoming like this founder and talking to gazillions of investors and not end up getting a investment. So if we can go to the next slide. So how much time would you spend when you're looking for your future husband or wife? Would you marry someone who comes up to you at a bar and say, hey, let's get married? Probably not. Or would you marry someone just because he gives you a diamond ring and say, hey, let's get married? Most likely not. You kind of want to know who this person is. And I also wanted to ask, if when you are looking for investors, so I understand you spend a lot of time in getting the investments because you've got your pitch ready, you got to get your pitch ready and all that good stuff. But how much time do you really spend on getting to know the actual investor? So let's go to the next slide with that question in mind. As you can see, the big bubble is from the Sun Tzu himself, from the Art of War. It says, if you know the enemy and know yourself, you need not fear the result of 100 battles. So this is one translation. I think one that's closer to real Chinese translation is, if you know the enemy and know yourself, you will win 100 out of 100 battles. So essentially, if you don't know yourself and you go into battle, of course, there's a 50-50 chance you lose. If you know yourself, but if you don't know your enemy, well, then again, 50-50 chance you'd lose. If you know yourself and know your enemy, and let's say enemy is much stronger, before you engage in a war, you're gonna go to him and surrender, or you come to a term with your enemy, so you don't actually get your butt kicked, if you will. So it's important that you know who you are and knowing who your enemies are. I'm not inferring that your investors are your enemies, but you do need to know your opposition. Of course, on the Western side, Socrates, in one of his more famous quotes, is "Know thyself." So let's start from there. Let's figure out who you are. If we can go to the next slide. So these are 5 stages that I sort of drafted. So first, at the top is ideation stage. So you have some ideas as a founder. Second stage is you go into the validation. So you've got ideas, and then you want to validate, hey, maybe this kind of people would want this product, and you start interviewing those people. Third stage is where you actually have the prototype. So you have the MVP, or minimum viable product, and you're actually testing with that. And then fourth stage is you're looking for market fit. So by this time, you already have pilots going. Maybe you even have some few paying customers. And the final stage, of course, is your scaling. So you know this is the right product market, you found the right product market fit, and your goal is now to grow. So may I hand it over to you at this point?
Yes. So everybody, please join us on the board, and we will give you 1 minute to help us test the water to understand a bit who is in the room now. So I will show you what we're going to do. We're going to drag one voting dot to where you currently are. So I work for Miro. We're in the scaling phase. So please show us with a voting dot where you are right now, so we have an understanding what type of room we have here. And I see that almost the half of the people are not on the Miro board. Please join us on the Miro board by just clicking on the link in the chat, and then you can put your voting about, so Jin has a better understanding who we have here with us today. All right, thank you. So hopefully, Jin, you have a little bit of an idea what the group consists of.
Yes, thank you. So this is great. So I see 1 dot in ideation, for example. Several dots are on validation. I think the yellow one in between is you're going between validation and MVP stage, which is perfectly fine. That's normal as well. The reason I created this, by the way, is so I can understand how much am I willing to invest in one of this stage. For example, ideation stage, I probably would not invest more than, let's say, 10,000 euros. Validation, perhaps a little bit more. MVP, definitely more than 10,000, and so forth. So this kind of gives the investors also a bit of a flavor on where and how much to invest. Having said that, I see most of you are in the MVP and the market fit stage, which is great. And I assume this is why you're looking to raise funds. So great. So now that we kind of know ourselves, let's figure out about our enemies or investors. But again, investors not our enemy. So if we can go to the next one, thank you. So what do investors care about? So first and foremost, obviously, return on investment. So how much do you need from me? Do you need 500,000? Do you need 20 million? Or do you need 50,000? And what do I get as an investor in return? And how much control of the company do I get? Do I get a board seat? Do I get to voting rights? Second, of course, is timeline. Some investors want to get their return in 5 years. A lot of VCs, for example, look to 5 to 8 year time frame. And finally, but not least, risk. How much risk is in the investment? So, for example, I think with Elon Musk wanting to go to Mars, well, I would say the risk is pretty high, even though he's a very good entrepreneur. So having said all that, there's a little link on the blue. So what that is a past Miro talk with Cocoon in the previous. Is you can check that out later, not now, later, but that link is there from the investors and the founder psychology perspective. So if we can go to the next slide. So what do the investors look for? So this is actually really, this slide, I should say, I give credit to this gentleman named Stephen Mankoff. And he's a very successful billionaire VC who originally lived in Silicon Valley, but he moved to Hawaii since. So he was in a nice Hawaii home during winter when he shared this. So I asked him, what are the 3 top things that you look for in an investor? And he gave me 4, actually. So number 1 thing is, of course, the team. By team, he means the founders. So how good is the chemistry among the team? How strong and focused are their drive? And is there a fit, cultural alignment between the team and himself as an investor? So the cultural alignment between the vision, shared vision, and so forth are very important between the team and the investor. So for example, if you care about helping people, but all investors care about is money, it's probably not a good fit. You want an investor who cares about helping people or sustainability and what have you. That said, second thing he mentioned is market opportunity. How big is the total addressable market? So obviously, that's important. If you have some product that's a very localized product and that can't scale beyond globe, then your chances of you becoming a unicorn is relatively small. And mind you, he's looking at a unicorn possibilities. Another thing that he said that I thought was really, really interesting is feature versus platform. So it's like Miro is a platform. It's not a feature. Feature is, so his idea is that feature has lower entrance barrier to entrance, and people or existing player can just add those features, whereas platform, it's much harder and you have the possibility to really scale and grow at an exponential rate. Third thing he mentioned is, well, of course, product and better mousetrap. And do you have a defensive, like, for example, intellectual property to protect your product from your competition? Fourth thing he mentioned is stickiness. So alternative or stickiness. By that, what he meant was, if your customer stops using your product, how much pain are they going to feel? For example, if I stopped using Miro, my pain would be pretty significant. We wouldn't be able to do this, for example, and a few other things. Yes, and share ideas and all the templates that Miro provides and so forth. So yes, it would be quite painful for me if I stopped using Miro. For your product and services, how much pain would it cause to your customers if they stopped using your product? So those are the 4 things that he mentioned, and I think those are really all very good points. Let's learn a little bit more about VC. So if we can go to the next slide. So as you can see, there are 2 parts to this slide. So on the left-hand side is the VC statistics. So as most of you know, 1 in 14 startups succeed, which means 13 out of 14 fail. VC is not that much different. As you can see, more than half the VC loses money, more than 50, about 50%. 35% returns money, what you invested, give or take. So basically 85% of VCs are useless to the investors anyway. And 10% returns 2 to 3 times, and only 5% returns 3 times or more. So that's 1 in 20 VC that will return 3 or more returns for you. And if we look at the right side, this is from a private equity or VC called Blue Equity. And his slide, I took his slide, by the way, verbatim. But essentially, they go through 450 startups per year. And these are not just 450 startups. These are qualified startups, meaning these have been referred by their partner network or through direct marketing. They've filtered these out. So these are already pretty stiff competition. Out of those 450, essentially, when everything is said and done, they only invest in 2 or 3 startups. So that's 1 in every 225. And he's actually one of the better ones, meaning he actually invests in 2 to 3 companies. He only sees 450. There are many companies. There's a question about how can 125. So what you are looking at is, so there's 225 plus 125, so 450. Out of those, 125 gets to the level 1 screening. So you've got 125, right? Out of those, 100 gets passed, which is on the right-hand side, and only 25 goes to level 2, which is the initial review. Out of those 25, 18 again gets thrown out, and 7 makes to the term sheet. Out of those 7 term sheet, 5 gets thrown out or pass, and only 2, maybe 3 companies get funded. Hope that explains the question that was on the chat. So the point is the VCs are very picky about who they invest in, and shall we go to next slide? Yep. So we come to the 5 P's of investment, which essentially means these are, so over the years, I came up with my own methodology, and being a consultant, I have to have methodology for most things that I do. And so it's called 5 P's, and it's basically prepare, pitch, procure, persevere, and perform. So obviously perform, meaning you have to be able to demonstrate that you have a business, and that's throughout the entire 4 P's. One of the reasons that the founder that we talked about going through 95 investors and getting all of €0 is because he did not prepare properly, in my opinion. So what does preparation mean? Well, first of all, do you know how much do you need? So have you done your business plan? Have you done your financial projection? Second question is, did you do research on your investors? How much do you know about your investors? Do you know about your investor as much as about your boyfriend or girlfriend? If you don't, well, you need to. So, did you meet you don't have to meet their family, but but you still need to know at least what their values are and so forth. So, and once you understand and you've done your preparation, next question is, are you sure you want the investment? And, at some point we feel like, oh, we really need the money. But really, when you get, especially VCs, angels might be a little better. I don't mean to, use the pun or anything, but if you really get funding from VCs, it's like getting into bed with a devil. And angel can be devil too, by the way. But anyway, the reason for that is because I've not seen personally founders last more than 7 years once they get their VC funding. So a lot of times they will change the management team and so forth. So be careful what you wish for. And the second question related to pitch is, of course, do you understand your investors and their needs? So by that, I mean, as we talked about earlier, some investors start from 12 to 20 million. I talked to one of the VCs in US today. He used to start from 5 million last year. This year, he says he's starting from 12 to 20 million, preferably 40 million. Some investor will start with $500,000. So there are definitely, you have to understand your investors. And we also talked about what industry do they invest in? Do they invest in technology? Some angels and investors only invest in software companies, some only in sustainability. So understand your investors. For now, we'll just focus on those two. And if we go to the next page, I get a lot of times people say, hey, give us the specifics. And if we go to the next page, yeah, those are the specifics indeed. So these are list of activities. So it's probably a little bit hard for you to read. That's okay, because I'll send you the entire color-coded version as a bonus at the end of the workshop as well. But very quickly, you can see on the left-hand most side is activities such as, do you understand your financial needs? Did you create your pitch deck to having dinner with your investors? The second column is things that founders have to do, and look at all those axes. Pretty much, you're involved in every step of the way. Next, third column over is things that investors have to do, and you can see that once you get into the pitch and then the procure stage, there's a lot of activities for investors to do as well. And the next column over deliverable is actually documents that you have to prepare and most likely get investors to sign. And then we have the comments. So again, we won't go through this in detail right now, but I'm happy to send you the list so you can get ideas as to what steps are needed. So if we can go to next page. So what should you not care about? Or what should you care about? And hint, hint, it's not the money. I had one Belarusian founder, he in discussion, he said, yeah, well, I asked him again, what are the three things he looks for in investor? He says, first thing is the chemistry. Second thing is a aligned value. And then third thing is valuation. And he says he used to only look at three things. Number one was valuation. Second thing was valuation. And third thing was valuation. So he only cared about money. And then when he got an investor, the investor didn't follow through. There were a lot of problems, and his first company went bankrupt. So it's not all about money. There are things far more important than money. So let's look at what those are. The next slide. So what should you care about? Obviously, you want to preserve as much equity as possible. So you don't want to give away more than 50% of your company. Second thing is control. So what do we mean by control? Well, how does Mark Zuckerberg control Facebook or Meta at this point without having 51% share? Well, he has all the voting rights because his share A shares or whatever, it gives like 100 votes, 100 times more votes than your common shares. So how do you maintain your control? How many board seats are you going to give away to your VCs or angel? That's always very contentious discussion. Does anybody watch Succession? Okay, never mind. Moving on. And then third thing, but also a very important thing is, of course, culture and alignment with the investors and the founders. Yeah, let's go to the next one. So what should you say and not say in the meetings? Well, do talk about the vision, because that's 50% of what you got. Chances are, if you're in the MVP and validation and market fit stage, you have some traction, but not enough traction to really get excited, right? So focus on the vision, where you're going. Give specific numbers and be honest. I think honesty is really important because the main reason people invest in you is not so much your company, it's you as founders. And if they cannot trust you, chances are they're not going to invest. So having this being honest and having this trusting relationship is critical, in my opinion. I mean, that's also true with your spouse, right? If you have a husband or a wife or boyfriend or girlfriend, if you don't trust them, your life will be pretty difficult, I would say. So what not to do? Some people actually asked about this, but yeah, don't tell them you're gonna use so much of their money in salary. You can kind of embed that into marketing or sales or R&D or something, but don't say, yeah, I'm gonna pay myself 5,000 euros a month in salary, because nobody wants to real. If it's reasonable, 1,700, 2,000, that's okay, but still, I don't think you need to talk about salary. No BS, and never say, oh yeah, the total addressable market is 1 billion. If we get 1% of the market, it's 100 million or 10 million. No, that doesn't. Some investors absolutely hate that. So I would stay away from those kind of statements as well. I'm sure there's a lot more things to say and do, but those are top 3 from the previous lessons learned sessions. Let's move on to the next one. And questions to ask. I think sometimes by asking the right questions, you can make things happen that was lost. So I think these are some of the questions, obviously what industry, ticket size and all that. But yeah, something like who is the decision maker and what are the decision making criteria, investment criteria. I think those are important to understand. And if we can go to the next slide. So here's a few things that you should consider. Do you feel the chemistry? Do you feel comfortable? Do you feel that the values are aligned? And do you trust the investor? Respect his or her judgment? Finally, one of the most important thing, and this is again from one of the founders that gave the feedback. He said, when somebody, one of the investor, when he calls, he gets all stressed. He's shoulder gets tense and he goes, oh no, him again. But same founder, when he gets a call from another investor, when she calls, he's like, oh, good, I get to talk to her and share burden and bounce ideas. So my advice to you as a founder, of course, is that stay away from the first kind of investor where he's going to cause you a lot of stress, and go with the second type of investor who you feel that you can bounce ideas and you can work with, not the one that stresses you out. Life is too short. Yep. So next, yes, valuation. Well, does everybody have valuation of your company? Do you know how much you're worth? Yeah. Well, to be honest, there's like I'm aware of at least 13 different ways. I'm sure there's a whole lot more ways, different ways to come up with a valuation. And it's a voodoo. It's not a science. It's just you kind of, especially at this stage. So once you're established, it's okay because you've got the history. Based on the history, you know what's going to happen in the future. But without understanding the future, it's mostly voodoo. So it's definitely not science. And what we want to do is cover a couple of more popular valuation methodology, one of which is Berkus. So what I'm going to do with this is I'm going to first kind of demonstrate the Berkus methodology. And then after our example, I'm going to give you floor back to Yair so he can go through the your own valuation of your company. So for the purpose of our exercise, we picked minute. So Mickey or Linky, are you there? If you can unmute yourself.
Yeah, we're here. Hi.
Great, thank you. Hello. Yeah, so Berkus method is basically based on 5 areas. Your idea, how much is your idea worth? How much is your prototype or technology worth? And how much is your team? How much is a strategic relationship, your partnership that you have in place worth? And finally, what is your sales traction? And basically each one of these 5 areas, you want to rank from 0 to 500,000. But as we do that, do you want to give a quick blurb on what minute does? So we can better understand what minute does, and then we can also use you as an example, if that's okay.
Sure, thanks, Jin. So we're Minute.works, and we are a digital platform where we are connecting pre-qualified student freelancers with startups and scale-ups to engage in study-related work, such as digital marketing, business development, and data analytics.
Super, thank you very much. Wow, great, great elevator pitch. So let's go to the Berkus method. So how much would you say your idea is worth between 0 to 500,000?
The question, do we have 500K to divide over those 5 or for
No,
each?
no, each
Okay.
one has a 5, yeah, 0, each one of those 5. So the maximum for total is 2.5 million.
Sound idea, probably 250, 300.
Okay, let's do 275 then, somewhere in between. Thank you. And how about the prototype? So not prototype, in your case, you already have a product. So how much is the product itself worth, you think?
300.
Okay, great, 300. And the team?
500.
Thank you, I agree. Yeah, and the partnership, so existing ecosystem.
Ooh, 500.
Okay, yep. And finally, from sales traction perspective.
500.
Okay, so we have the valuation of approximately 2.075 million for minute, so about 2 million euros for minute. And actually, that's a pretty good number. Interesting thing about valuation. So this is minutes valuation, according to founders. Now, if you ask the investors to do the same thing, they may come up with a different number. But this gives you a starting point, discussion point as to, hey, this is why we're worth 500,000 on, let's say, partnership, because we've got so many critical partnerships. And you can engage in dialogue with your investor. Having said that, wanted to mention one thing. So before, up until I want to say like 5 years ago, average valuation in US, this is US where valuation is much higher, was about 2 million. So you didn't even have to have a prototype almost. You could have a really like super alpha version of a prototype and you're suddenly worth $2 million, dollars, not euros, but dollars. And these days, that same company, so the average valuation of the startups have gone up to 3.7 million in US. Well, this tells us one thing, which is that there is a lot of money out there from investment community perspective. And there's a less and less really good startups. Another interesting fact, so I was working with this startup that was worth 1.5 million euros in Netherlands. They went to Silicon Valley. A month later, we were having a call, and you know how much they were worth in Silicon Valley? 1 month later, not much different from product or progress. They're worth $7 million. So the point I'm trying to make is that valuation is very different depending on where you are, whether in Netherlands will have different valuation than, let's say, Estonia, which will have different values than US. But point is, it's good to understand from cultural perspective as well, but we won't get into that just yet. So let's get to the, thank you, Yair and Minute, Linky and Nikki for your help. Let's go to the next slide.
You want to do the exercise now,
Yeah,
right?
yes, I'm sorry. Yes, sorry, Yair.
All right, so for everybody
here
with us on the Miro board, and for the people that are in the Zoom room, you can join us at the board, and we created a working station for you to do the same exercise that Minute just did. Thanks, Minute, again for giving us an example. You can just choose one of those working stations and you can fill out your startup name and then you can try it for yourself. I will share the board link once again, and you just scroll down on the board, then you will come to the working stations, and I will give you 3 minutes to fill this out. And of course, this is your first time perhaps, so it doesn't have to be correct, but it makes you perhaps think a bit more about how you should go about your first valuation. So we'll put a short timer for 3 minutes to give you a chance to write this out for yourself. Okay, let's move back to, or do you want to zoom in on some working station? What do you prefer, Jin?
Yeah, let's look at a couple of numbers very quickly. We can tally the ones that have been finished. So we're looking at 1.5 million. Yep, that sounds pretty good. Visualize. And which one is this one? I can't quite see the total, but I'm guessing 500,000, 1 million, 1.15. Okay, that's pretty good. Yeah. So yeah, well, congratulations. You've come up with your first valuation of your company. Another popular method that's used by VC is called VC method. And essentially, they get the income, projected income. So you have to figure out a few things first. How much income do you expect, let's say, in 5 years? So in how many years will you exit? What kind of return am I looking for? And how much do you need? And at the end of the day, you put all those numbers into this formula. So it's net income times your multiplier, of course. So if you're a software company, it could be 10, it could be 20. If multiplier might be a little lower, if you're a hardware company, it might be 3 or 4. But anyway, so your net income times multiplier divided by 1 plus rate of return desired. Do you want 30% return, 40% return? To the power of the number of years that you are willing to stay with the investment. So 5 years, 6 years, 7 years. And so to just give an example, let's say I'm investing in a company and I want to sell the company in 5 years. So I want the company to exit in 5 years. And in 5 years, the number is going to be 2 million euros. The income is going to be 2 million in 5 years. It's a software company, so multiple is 10 times. So meaning the company is going to be worth 20 million upon exit, right? 2 million income times 10 times multiple. So exit value is about 20 million, and I want 40% return per year for the next 5 years from this company. So basically, I end up with post-money valuation of 2.7 million. What that means is that 20 million 5 years from now is worth 2.7 million right now. And I'm going to invest in 1 million. So your pre-money is 1.7 million. So basically, I get 37% of the company. So I know this is way too fast. That's okay. It's just a formula right here. You can play with this formula later, or happy to go over these with you at another time.
And there's also a link on the board. So if you click on the VC method that's underlined, you can get a more comprehensive explanation.
Yes, thank you. Yeah. So let's go to financial projections. So basically, it helps you. It's one of the gifts that I'll be giving you later, but it's going to save you a significant amount of time and hassle and headache and tears. It does a lot of thinking on your behalf, and by just simply filling out, it has like 23 sheets within the workbook. But you only need to fill out 6 of them, and it'll automatically calculate income statement, balance sheet, and cash flow statement for the next 3 years. And don't spend too much time on a financial projection because it's not going to be exact. It'll never be exact. If it's exact, then it'll be really strange. So let's go to the next slide. Term sheets. Another thing, the two things that you're going to need when you approach investor is your pitch deck, of course, and your term sheets. So what should your term sheet include? So it depends. First of all, you have to determine is it going to be convertible notes? Is it going to be equity swap? Is it safe? So you have to decide what and how much do you want. Your pre-money valuation, as we talked about, voting rights, liquid preferences, and so on and so forth. So there are a few important items that need to be in term sheets. Again, we'll give you a copy of an example of the term sheet later as well. So if we can go to the next page. Yes, here it gives. You can download from this link, and Yair is going to give you the link anyway, so you can log in later. Bonus is a step-by-step. That's slide 10, where we had all the list of the detail, having dinner, when to have dinner with the investor, and so forth. I'll send it to you if you send us email requesting it. And let's go to, one warning. Please download it and copy it first, because if you make changes directly onto the sheet, the other 500 people who has access to the sheet will be able to see your numbers. So probably not recommended. Yeah. Okay. If we go to the next slide, we're nearing the end. Feel free to reach out and learn more. And then let's go to the last slide. Again, here's the Cocoon again, and you can click on, you can use the QR code to get the link and get free mentoring from Cocoon as well. So that is it from my perspective. Sorry. Yeah, thank you.
Thank you, Jin, so much. We're going to go to the Q&A soon. First, quick remark regarding the Miro Startup Program. If you didn't sign up yet, go to miro.com/startups. Apply as an early stage startup, or perhaps you're a scale up, then we have another offer for you. If you're an early stage startup, we invest $1,000 in your business. And you can also, if you find it difficult to use Miro, you can join one of our How to Miro for startups. We have one next week. So you can just sign up there and you'll learn the basics and a little bit more advanced features. And also feel free to stay in touch via LinkedIn. And then I would like to invite everybody to drop their questions here on the question board that we showed in the beginning, and we have already 4 questions, but for everybody that still has questions, don't do them in the chat, but come to our Miro board and you can leave questions here for Jin on this part of the board. On the left side, you can find the place to leave your question. So let me go to the first question. Angels can be devils as well. Can you explain this more in detail? This was a quote by Jin Han today. So they would like to understand a bit better what you meant here.
Great, thank you. Thanks, Yair. So angel, of course, is referring to angel investors. So again, not all angel investors are created equal. I've seen quite a few founders who wanted to kick out an angel investor. They were raising money to pay off the angel investors, they can kick them out. And obviously at that point, they've become a devil because they're making life difficult for the founders rather than helping them.
Okay, thank you. Then the next question, how do we get to know investors? So you know one already, you know Jin, but how do you get to know other ones?
Yep. So, well, that's where research is needed. There are many platforms, whether it's Lead Funder or other. You can even do research on the online, and depending on angel or VCs, you can reach out. That doesn't mean that they'll return your call, but so the best thing to do is to know someone who knows the VCs or angels to introduce you. So having said that, once you get to know them, don't try to, worst thing you can do is trying to close the deal on the first meeting, because nobody's going to give you even 10,000 euros in first hour of meeting. So you have to plan long strategy and really try to understand the values that investor might have over a series of 4, 5, 6 meetings.
And I don't know from who this question came, but send me an email afterwards, because I had the privilege to talk with about 150 VCs over the last year to partner with Miro. So I have quite a big list. And if you have a specific niche that you're operating in, I can even link you to the right VC that might be the perfect fit for you. So You can send me an email on yair@miro.com to see if we can find a VC that meets your business model. All right, next one. This is a long question. The statistics of women founders getting an investment is quite small comparing to men because it's a male-dominated space. Do you have any positive feedback about women business angel groups?
Positive. Well, so first of all, the statement is absolutely true. I think 1% of the funds in VCs generally go to female-founded companies, which is ridiculous, absolutely ridiculous. Having said that, there are also female group of investors who would only invest in female startups. They're well, happy to make introduction to a couple of them if you like, but this is very true. And what was the sorry, I can't quite read. Let me see if I can blow it up.
Do you have any positive feedback about women business angel groups? So if you know business angel groups for women, or
yes, there are a couple, as I mentioned, that I'm aware. That again, it's run by female, and they only invest in female startups.
Okay.
And I also would say that we need more female founders.
All right, thanks. And then, is it normal practice that investors gives investment for IPA?
It can, I think. Well, so if basically investor is not giving investment for the IP, but they're trying to buy your company, right? So they're not paying for, they're paying indirectly for IP, but they're getting shares of your company, which means that they own the shares of the IP. They don't own it literally, but by owning your company, they have access to your IP.
Okay, cool. And then another question regarding, is it wise to have an angel investor sign an NDA before you start?
Very good question. Depend how important is it that how important is technology? Usually angels and your partners and VCs don't typically like to sign an NDA. I've had some cases myself walk away because it wasn't interesting enough for me to sign an NDA with. At the same time, I have no qualms about signing an NDA, but and I've also seen cases where they make you sign all these NDAs, and in the end, company went kaput in like 6 months. So, yeah, I guess you really have to evaluate how important is this NDA to you.
Okay.
But in general, I would not suggest it.
Okay. All right. So it's a little bit about your own radar and own judgment if you feel this person is trustworthy.
Yes, exactly. I think that's the most important part. If you trust them, you don't need an NDA from them. Yeah.
Is it common for an angel to ask for a EBITDA? And if yes, when do you share this? What's the moment?
Yeah, I think any investor would be interested in your EBITDA if you have it. I mean, and you should share it when things get serious. So when they're going through actual due diligence, which is like step 25, I think, on the list that we have. But yeah, it's not something you should give away too easily.
Okay. And then how to gather a strong team for investment when we don't have money? Okay. It's a difficult question.
Yeah. Yeah. Well, founding team is important. Absolutely. Very important. And how do you get your team? I think 3 things: finding people with similar values and similar vision, and similar values, I guess is the best way to put it, who share the passion that you share about particular technology or sustainability or what have you. Second thing is create a vision. I mean, do you know where you're going? If you don't have a product yet, it's probably not going to be that easy. But if if your mission is to go to Mars and colonize Mars, I'm sure you'll be able to articulate that and able to find someone who's like-minded. And so I think finding people with the similar value, having a vision, and thirdly, ask. If you don't wait for them to approach you. You've got to approach as many people as possible. You can ask, for example, Yer or me, hey, I'm looking for this kind of founders. Do you know anybody? So you can, even if you don't know the person directly, you can ask your network to introduce someone who might fit your profile.
All right, thank you. And then can you elaborate on pros and cons raising capital in the US versus Europe?
Oh, great question. Yeah. Well, pro for US, they give you higher valuation. They look at different things than Europe. And cons for US is that they'll probably want to meddle with your business. So they'll tell you a lot more than what a European investor might tell you what to do and what not to do. The pros for Europe, obviously, is local if you're based in Europe. Con is they look at different things. They're gonna ask you what your revenue is, whereas US investor might ask you how many eyeballs do you have, meaning how many users do you have. They don't care as much about your revenue or profitability, whereas I think European investors focus on the numbers and numbers and numbers. So US looks at the vision and where you're going to go. I think European investors tend to look at where you are currently and where they think you'll go.
And is it also true that in the US they really see failure a bit more as a badge of honor, where in the Europe they're a little bit more strict on results and they find failure less of an accomplishment?
I think that's also true. Yeah, absolutely. From cultural perspective, failure is indeed a badge of honor. So if you failed, statistically too, if you've had a failed startup, you're 19% more likely to succeed in the next one than someone who's never done it. One more advantage of US investor, I guess, is that if you're thinking to expand into US, they can help you, probably. But if you're thinking to expand in Europe, European investor is probably better.
Yeah, but expanding in Europe is difficult with all the different cultures and languages.
Yeah, for sure. I was actually having a discussion today about this with the VC that starts with 20 million. He was saying, well, we're saying basically California. He was saying a single state could be a country, and California, if they were a country, they'd be the 5th largest economy in the world, ahead of Russia and a bunch of other countries. So,
and we're going to the next question. I love it that there's so much questions. Thank you. Keep them coming. Really appreciate your input. What if you hired a C-level executive, but he comes from a big corporation like Google, and he works like a black box in his department and with other? He has great value for his investors, but alignment working with him actually sucks. How do you go about this, Jin?
Well, I would say fire him. I cannot emphasize how important the culture is. So I'm not sure what value he or she brings. So the corporate hires have a pros and cons. So they can have the structure, they see the big pictures, and they're not afraid to talk about large numbers. The con is that many of them don't know how to get their hands dirty, especially if they're at executive level. So as a startup, you need to have someone who's willing to get their hands dirty and wear multiple hats. Well, these guys are used to having people doing things for them. So that's a big no-no. Unless they're also humble, they might have this arrogant attitude. I'm from Google or whatever. And thirdly, if there is no cultural alignment, I think that's a really bad sign. I don't. Yer has a culture events as well, like this, workshops, and culture is so important.
Yeah, for
you
sure.
should check out. Yeah, you should check out some of the Yer's previous culture workshops.
Always welcome. And then next question is, any recommendations regarding equity dilution structures, like pre-seed this much percentage, seed this much percentage? Is there like a golden rule here?
Very good question. dilution is a fact of life. So again, I think three things I would say is best thing is if you can limit number of investment you get. Second thing is make sure you maintain the majority when everything is said and done. And I don't mean pre-seed. If you're going to have 5 rounds of the fundraising, by the end of 5th round, make sure you still, as a group of founders, have the majority stake. And then third thing is plan ahead. So figure out if you're going to need, how many rounds you're going to need before you have a sort of desired outcome. The desired outcome could be exit or what have you, but yeah. But I can't really say, because every situation is so different. You know, if you're so dire for money, and if you don't have immediate 200,000 euros this month, you're going to go bankrupt next month, you might have to give up more shares and be more diluted than if you had more runway. So planning ahead is absolutely critical to minimize the dilution, I think.
Cool, thank you. And then, what do you think of a team who work on it part-time next to a regular job?
I think depending on what stage you're in, that's sometimes has to be a necessity. I've worked with founders, 3, for example, this group, one guy's full-time and the other 2 guys are half-time. They work full-time with the startup, but they work part-time with their normal job. But I think what they did do right is that they set a criteria when the 2 founders who are working who has a part-time job will quit. So if they reach certain revenue or profitability, they'll quit and be 100% devoted to the company startup.
Okay, thanks. And then how about an investment memo instead of a pitch deck? What is your opinion about this?
Yeah. So you could have a 1-pager, but I don't know if the 1-pager will be able to carry as much information, or because at the end of the day, I think you have to get investor emotionally involved with your startup to have the best chance of getting investment. And I'm not sure if the memo or 1-pager can do that. So you know the old adage about Aristotle, the pathos, ethos, and logos, right? And I would say pathos, or the emotional component, is the most important component, 60%. Whereas logos, the facts and so forth is 10%, and the ethos is the credibility is more like 20%. So for you to fully get emotional engagement, it probably is best if you can have some pictures and colors and all these in the pitch deck. But I mean, yeah, memo will work, but my recommendation is to appeal their emotions.
Okay, thanks. Yeah, it depends a little bit also to what you said in the beginning, right? How you need to know your investor before. Perhaps
Yes.
they're really data driven and they are more to text and numbers than images. Next question. I find this question really, really interesting, and I'm curious to see what you think of this. Is it good or bad to have a team of 3 brothers from an investor's point of view?
Wow. Usually not so great.
Really? Okay.
Yeah. So even today, I was talking to this group of founders, and they were having some problems because 5 of them. They're very close friends, and so there's some certain expectation and stuff. But having said that, I've also seen sisters whose company I won't mention. They work amazingly well together because they understand each other so well. So I guess it really depends on the type of relationship that you have with each other. If you have such a trusting and loving and well-rounded situation, then great. I think that's fine. but you really have to set that expectation. I had this is back in US. There are two Polish sisters that started a company, and they were working really well together. After 5 years, some things started going wrong, and they had exactly 50-50 split, and that was a big problem because one sister wanted to go this way, other sister wanted to go that way. And basically for like half a year, I was counseling one of the sister on how to handle the situation. Eventually they got back together, and then they're doing well again, but it could be a dicey situation also.
Does
Two-edged sword.
does Link here or maybe has an opinion on this? Do you already talked with investors that said something about your sisterhood, that it was an advantage?
For us, it's actually seen as an advantage. It's also because we have built a platform together a few years back. So, but I think it's always a tricky thing working with your sibling. So I would never work with my sibling because it's my sibling, right? It's for us, we work together because we really complement each other.
Yeah.
I think what's important to really realize is really know yourself, your strengths and your weaknesses. And if you actually complement each other and can work with each other, I mean, you can be best sisters, but maybe not best co-founders or colleagues. So if you assess yourselves in that and in the company, then I mean, for us, it works really well.
Okay, thanks.
Yep.
All right, then we have
Thank you. That was a great summary.
two more questions that are related to each other. How long does it take from meeting investors to actually getting the money on your account? It's a really
Very good question. Usually rule of thumb is 3 to 6 months.
Okay. And is there then a moment that after 6 months you would say that is too long and you should start looking for other investors?
I would strongly recommend it. Again, this year it happened to two founders where on the day of the signing the term sheet where they were supposed to receive the money, the investor pulled a rug right below their legs. And so they said, we're not going to invest in you on the day that they were supposed to sign. And the warning sign was they kept on delaying and delaying. So they were supposed to sign in, get the money in August. September still wasn't in, and by end of October they said no.
That's nice. That's good advice. All right, then the last three questions, and of course we still have time for more if you still want to post some more questions. So how do investors see if founders are okay, so what is the opinion of investors in seeing that it's a serial entrepreneur and that this person is involved in more startups but in similar domains but with different ideas?
Depends how successful this founder is, and if this founder is doing the company having multiple startups simultaneously, then that's a warning sign that he's not or she's not focused. But if he was very successful in one and he's starting another company within the same domain, I think that's a very positive. We talked about founders that failed in the previous startup to 19% more likely to succeed. Founders that have succeeded in previous startup are 20, I think they were saying like 27% or 29% more likely to succeed in the second startup.
Okay. And then thanks. And then the last two questions. This one is, I think, a difficult one to have a clear answer on. Can you explain the road of value increase? For example, day one, the company is worth X, and after milestone A, the value increases to Y. Could you elaborate a bit on this?
Well, I think there's really two factors that's going to increase your company, and that's your product development. How far are you with your product? And then second thing is, what is your revenue? What is your sales or your profitability? So it doesn't, just because you reach a certain milestone doesn't necessarily get you a higher valuation. Like I say, I would say the thing that will really help your valuation is your sales.
Okay. All right, thank you. And then the last question, do I need an MVP to approach investors?
It's a lot easier if you have it. Yeah, so if you have to describe it, so there's a difference between someone coming to me and say, I've got this idea. And yeah, I've validated with this many people versus if they bring something and say, hey, here's my product, it's still a work in progress, but you can see and touch it. Or it does, if it's not hardware or software, it's okay to look at it and look at the software.
Yeah.
So there is a huge difference. And in general, if you don't have an MVP, it's not likely that you would get an investment, or it'll be much difficult to get investment, number one. Number two, the valuation at which you will get investment is so low that it's probably against your interest.
Okay. All right. Thank you. Are there not more questions? If so, please drop them on the board. And otherwise, I think it's also time to start wrapping up.
Yep.
I really think that it was an amazing interactive Q&A session. We had the most questions ever in a Miro startup event. So yeah, they were really happy, Jin, oh, there's one more question coming up. I was too quick. Let's see what, oh, it's going to be a thank you. So, all right, so nice. So Jin, I would like to thank you. It was really interesting for me, a lot of new information, and I'm really happy that we could share this with our Miro startup community, really valuable. And I think that also, if you look at the churn rate, we started with 40 people in the Zoom room and we still have over 30. So that means that everybody almost wanted to stay to the end. I would like to invite everybody to contact Jin if you have any additional questions via his email. Subscribe to the Cocoon program where he is part of. And again, don't forget to subscribe for the Miro startup program. I think there's nothing more left to say. So I'm gonna ask Jin one more time maybe to say something to the group, and then I would like to call it a night and wish everybody a great evening, morning, wherever you are, and hope to see you at our next startup event. And
So,
also, thank you very much for your active participation, of course.